Hey guys, Paul Kelton here, host of GRID Charleston. Last night was an incredible event. We dived into one of the most important and misunderstood parts of real estate investing, how to leverage real estate to save on taxes using a 1031 exchange and other strategies. Before we get into that, I just want to take a quick second, thank our sponsors who make GRID possible, who keep these events free for everyone. Coastal Equity Group, Mitchum Law Firm, Coastal Creative Media, Sweetgrass Capital, Matt O'Neill Real Estate, and Tide Property Management Co. These are local operators doing actual deals here in Charleston. We appreciate their support. Now, when it comes to 1031 exchanges, a lot of investors think they understand them, but most don't, and the mistakes get expensive really fast. So I brought in two people who live in this world every day, Eric Bradshaw and Johnny Chandler. They're not here to talk theory. They're breaking down real transactions, real timelines, things that investors consistently get wrong. They are taking us through 20 years of experience in 1031 exchanges, and we are learning from the mistakes that people have made, very expensive mistakes. In this episode, we cover when a 1031 exchange makes sense and when it doesn't, how the clock really works, and advanced strategies most people don't even know are options. And if you want to be in the room for conversations like this, GRID Charleston meets every third Tuesday of the month. Doors open at 5:30 p.m. Event starts right at 6 o'clock. Each month we have a different speaker and a different topic. We do a deep dive analysis into that topic with the expert in that field. GRID events are completely free starting next month on February 6th. We're adding deals, donuts, and coffee for the first Friday of the month. It's going to be at 9 a.m. at Bloom Coffee Shop in downtown Charleston. It's a daytime event where people can pitch real deals, raise capital, and make connections. You can find all upcoming events and register at gridcharleston.com or follow us on social media. Let's get into 1031 exchanges and other tax advantage strategies.
For those of you who don't know me, my name is Paul Kelton. I'm the host of GRID Charleston. GRID Charleston is a community where we do deals, build wealth, and create community together. So this is your first GRID event. Welcome. So how the event was laid out is we'll do a couple of intros and we'll bring up our special guests. We meet on the third Tuesday of every month. We always have a special guest in a different aspect of the real estate cycle. And they're experts in their field. Do a lot of Q&A, and then we'll open up to the room, and then we'll let anyone here ask the questions that they want to ask for our special guest. So before I get started tonight, I just want to take a moment to GRID. All of our events are free. All of our events are free because of our sponsors. So just want to take 1 minute, just go through each of our sponsors. I think for being here tonight. So let's start out with Chris Legbeaver.
Hey, good evening, everybody. My name is Wyatt Bolins. I am a business development associate at Coastal Equity Group. I was great seeing some familiar faces and one of the new ones. We are a direct hard money lender based right here in Charleston. We do rentals, fix and flips, ground construction, and we also do multifamily. So anything that basically you're looking to do with the residential space, we'd love to talk and see if we can help you out on your next project.
All right, thank you. And Mitchum Law Firm.
Hey, Lenny Mitchum. Good to meet everyone. Do mostly residential commercial closings. Probably more residential than commercial, but if y'all need help with closing, just let me know.
Lenny. Coastal Creative Media.
Andrew, Coastal Creative, your one-stop shop for all of your media services. So houses, commercial, residential, photos, video, drone, agent branding, media services for meetups, live streaming. So give me a call.
Thank you, Andrew. Sweetgrass Capital. Jared's here. Yeah, I'm Jared Odson with Sweetgrass Capital. We do four mortgages, like first mortgages for conventional VA, FHA, grade rates, that kind of stuff. We have a lot of stuff with Paul's parent company, Mountain Real Estate. So thank you, Jared. We had Jared last month come in. Jared is the owner of Sweetgrass, but he also owns a lot of real estate, and he kind of opened up this playbook about how he transforms neighborhoods and communities. It was super, super insightful. Afterward, I went to Jared, and we kind of did a walkthrough, and I posted some of it on social media about the neighborhood that the things that he had bought and what he had done. And we were at his office, and he was like, "Hey, Paul, I've got all this audio visual equipment that I'm not using that you could really use for grid. Do you want to use it? And I said, absolutely, we do. So I just want to thank Jared and Sweetgrass Capital for just donating this really, really nice equipment for us tonight. So let's just give a round of applause for all our time. All right. Okay, so tonight we are going to be talking about how to leverage real estate and single tax 1031 exchange basics. So, this one, I wanted to make sure we got a ton of value tonight. I asked around, I thought about it really hard. Who are the most knowledgeable people in Charleston on 1031 exchanges? And one name kept coming up. Well, two names, Eric Bradshaw and Johnny Chandler. They are our special guests this evening. They are some of the most knowledgeable people, really great people to work with. I've done a few transactions with them in the past. I know some people in the room have as well. So I would like to invite Eric Bradshaw and Johnny Chandler up to the front. Let's give them a round of applause. Thanks. Thanks. Right. So let's just go ahead and get started. Eric, your name comes up a lot when I'm talking 1031 strategies with clients. How did you get here? So kind of like give everyone a little bit of background on yourself in the room. Like, who are you? How did you get here? Why are you, so involved? And just kind of give us a little bit of background.
Well, I moved back to Charleston in about 2001, and where I was given my very first job as an attorney. And from there, it was only a short stint that I became a partner in a real estate practice. For those who have been here since dinosaurs roamed the earth, it was the former Davidson and Bennett Wigger firm. And so Eric Davidson and I became partners, and that's where I started with the primary focus of real estate law. And, parallel with that, obviously, my background is in tax law. And so 1031s was just a natural segue when you marry tax law and real estate law together. So I've been really doing the 1031 since about 2003 or 2004. So it's been a long, long run with them. And they just kept growing and growing and growing and demanding more and more of my time. In the interim, it went from Davidson and Bradshaw to just Bradshaw and Company. And Bradshaw and Company has just been wound down so that we could focus pretty much exclusively on the 1031s going forward. So the new entity is 1031-X LLC. So pretty easy to remember. But yeah, it's pretty much just exclusively 1031s going forward on that. But that's my background that led me to come in here.
Sweet. And Johnny, walk us through your background and how you ended up doing this full time.
Yeah. So my background's definitely not so traditional. It's engineering degree, mechanical engineer. And, that brings an eye for detail, an eye for numbers, and just really kind of understanding the nuts and the bolts of things. Progressive career, 20 years of management and oversight and things of that nature. And, got lucky early on when I moved to Charleston in 2012 to meet Eric through our love for fitness, and, became best friend. And it just became natural that he would bring me in to help as, it just became more and more and more. And he said, we're going to focus on this. And so, he saw my eye for detail, my bubbly personality, and the ability to help people and that desire. So, been helping him for about 2 years now, and just watching things grow and grow and grow. So we're excited to keep up with it and trying to take the load off of his shoulders so he can maybe, see the sunsets more often. But we're here together and we're rocking and rolling.
Sweet. Well, if y'all don't mind, I'd like to dive right into the meat of it. So kind of walk us through, just so we're all on the same page in the room, what does a typical 1031 exchange start to finish timeline look like?
I mean, the nice thing about the IRS regulations are from the commencement of that first sale, the first transaction, until the very last possible moment is 180 days. There's a couple of hurdles in between there. The biggest one and the most onerous one that we really don't love, but somebody thought that a 45-day window to identify was a great idea. So really and truly, if you look at it from, when you start, it's 180 days, but really it starts before you ever sign the paperwork in that closing attorney's office. Being eye on the market and keeping, an eye out for what you're looking for or what you want is probably key to making that 45 days a little bit more digestible. But the short answer is 45 and 180 days. So a month and a half and then 6 months to get everything, completely wrapped up with a bow on it. But there's a lot of work that goes in even before you close.
Are there any exceptions to 45 days?
No bueno.
Historically speaking, no. About the only instances of ever having extensions on those very strict deadlines, and I mean, even if it falls on Christmas or another holiday, it's that deadline. Were the recent hurricanes that we've had around the area. And then all of a sudden, the federal government says, okay, we are extending all tax deadlines, which did not exclude 1031s until, say, this date. Prior to that, for 30 plus years, there's never once been an extension for one of the 1031 deadlines. So, I mean, you really can't gamble on whether or not we're going to have named storms and whether or not what the federal government's reaction is going to be insofar as trying to, assuage those that are impacted by it. But I wouldn't bank on it. As a general rule, those deadlines are firm.
So if you have 2 days left in your identification period and no deal lined up, you're praying for a hurricane.
Ooh, no, I wouldn't go there. Let's not do that to the low country. I think there's some other options there. Let's be real that communication is key. And if you've gotten down to that second, and 2 days left, there are other alternative investment options, but I think the key to probably understand is that identification is exactly that. It's an address, a TMS number, something that you're targeting. It is not a contractual, ratified contract. It's not anything along those lines. So probably, hopefully, you found at least one that you can at least list and then extend that
How
window.
many properties can you identify before the 45 day?
The rule of thumb before we start whipping out the calculator is 3.
Okay.
3 means that there are 0 calculations that go into it. You can take, $100,000 property and turn it into a $100 million property, or 3 properties, that are worth $100 million. When you go above 3 is when you start doing what the G6, which is a sub clause of the 1031 regulations, where you start doing the 200% rule. So you cannot exchange, and this can be aggregate numbers of exchanged value up to 200% before that. So, the way I like to describe it is you may have 10 lots if you go by a part of a neighborhood. Well, that's technically 10 properties, 10 closings, etc. And so that would indicate the 200% rule, but you probably, if it's raw land unimproved, probably not going to actually exceed the 200%. So it's things like that. So 3 is the rough rule of thumb, but you can really and truly do, I don't want to say infinite, but far more if the deal's structured correctly.
What's something that most people misunderstand about 1031 exchanges?
Probably the number one thing that everyone is very common is that what is the reinvestment rule? How much do you have to reinvest if you want to do a complete exchange versus a partial exchange? So, if you sell $1 million property, but you're like, okay, I only have about an $800,000 gain in it. Do I only have to reinvest the gain? Is it just an $800,000 investment? Or, you have your payoff and whatnot. You have maybe $600,000 in net sales proceeds that's going towards the 1031. Is the net all you really have to reinvest, because otherwise you don't have any other money but the net. And so that gets confusing. The answer to that is that from a 10,000 foot perspective is, generally speaking, the IRS wants to see you go from a certain amount of equity to a certain amount of equity or more. So $1 million in investment property, hopefully when the dust settles from the exchange, you've just simply gone to another $1 million or more piece of property. Now, that's not a super sharp number. There are a number of deductions that could come in and allow a little forgiveness if you end up with 950,000. In theory, 100 million to 950,000, so that $50,000 deficit there, it would trigger capital gain tax. But most of the time, you'll have on those numbers more than $50,000 of deductions. Your commissions on your first sale probably equal that anyway. So yes, a little bit of gain triggered, but you have deductions to wipe it out, but still a zero wash. But if you want to do a complete exchange versus a partial exchange, plan on doing for equal or greater value. It'll just keep the math simple. I mean, you don't have to get so bogged down to more complex concepts such as mortgage, food, things of that nature. So just buy the math will work.
Sales price to sales price, net to net, however you want to look at it.
Yeah, you said gross to gross, and that spoke to me.
Yeah,
Yeah.
sorry, gross to gross.
So
I said net to net because
gross number to gross number has to be equal or
Yep.
greater.
net doesn't come into it.
If you want to do a complete exchange, you could still probably run the numbers and say, well, listen, what I want to buy is still $100,000 shy of what I sold. You still may get the lion's share of the tax savings. Are you going to trigger some gain? Probably. But are you still getting a bunch of benefit from structuring it this way? Probably still, yes.
So you mentioned partial exchange. So kind of walk us through, what does a partial exchange look like?
Any exchange where you end up owing a little bit of tax in the deal.
Yeah.
So it's just not complete exchange. You're not, deferring every red cent so that the government doesn't get anything, So like I said, if you end up selling for $1 million, but what you really find is the one deal that really makes the most sense, it's 900,000. You may owe a little bit of tax on that $100,000 difference.
Yeah, it's probably important to just say that the whole premise of a 1031 is to maintain as much of your capital as possible to reinvest. It's to prevent you from penalizing as you try to buy up and invest and grow the, um, the amount that you have out there. So it's never a forbearance; it's more of a deferral. So that's probably like 101 to start with. That's what we're looking to do and to assist you with, and that's what you're doing as you move around in multiple transactions. So when we have that partial, it means that maybe you carve a little bit out, but it makes sense because this is the property that's just got your eye at the time, or it's the only one that you found with 2 days left.
Yeah.
Kind of scenario.
Gotcha. So when does, just like generally speaking, running a cost benefit analysis, when does doing a 1031 exchange make sense versus not doing a 1031 exchange?
I would say that hurdle's pretty low, right? So our fees are basically just a flat fixed fee based on the number of closings you've got. An initiation on a normal straight exchange would be $2,000 roughly to get it going and get the exchange started, and then from there it's $950 for every other closing, whether that's more sales property that or a relinquished property that are the sales proceeds are going into the exchange, or new property that you're buying and coming out. Every closing afterwards is $950. So 1-to-1, that's $3,000. That's a pretty low return on investment hurdle to cross to defer those capital gains taxes, even if it's
so
a
if your
partial.
taxes are going to be more than $3,000, then hypothetically a 1031 exchange makes sense, right?
That's probably,
Hypothetically, you're going to be saving money.
yeah, that's probably a good rule of thumb.
Okay. Sweet. Now I do want to talk about just a couple, and we don't have to get too advanced here, but just other advanced strategies, just to cover, all of our bases. So I've heard of reverse 1031 exchanges. I spoke with a couple people in the room before we started. They've done reverse 1031 exchanges, but it's something that I personally didn't know about until just a couple of years ago. Can you guys walk us through, what does a reverse 1031 exchange look like versus a traditional 1031 exchange?
A reverse exchange is just simply where you're changing the chronology of the transaction. So almost all 1031 exchanges are you sell, and then you have a qualified intermediary hold the money for you, and then you buy. Pretty straightforward. Reverse exchange happens where you have to buy your replacement property before you are able to sell your relinquished property. The deal was presented to you, you weren't ready for it, it's good, or there were a lot of delays on your sale and it pushed it past what you had already contractually agreed to buy. The bottom line is you're changing the chronology by buying first and selling second. As we just talked about in a forward exchange, big rule of thumb is you're not supposed to touch the money. Qualified intermediary holds the funds for you and then eventually transfers it to the closing attorney for the purchase of your replacement property. When you're doing a reverse exchange and you're buying first, there's no money that you have a qualified intermediary hold because you haven't sold anything yet. The big rule of thumb on a reverse exchange, though, is you can't hold title to both properties at any given moment in time. So 95% of the time, it's the property you're buying that has to be temporarily vested with the qualified intermediary. If you have financing for the purchase of that property, and it's a residential deal, that gets a little problematic where you have to explain to a lender, and Fannie Mae, Freddie Mac won't do it. But if you explain to a lender, it's like, okay, our clients are the purchasers, they're really going to be the borrowers, but we're going to have this strange LLC over here with a bunch of qualified intermediaries sign the mortgage. Is that going to be okay? So most residential lenders can't get that past underwriting. Commercials typically can do it all day long. In those situations, we go to the distant second and would have to hold title to the property that's eventually going to get sold instead. That comes with its own host of complications insofar as, trying to explain to the closing attorneys why they don't want the qualified intermediary signing all the title affidavits and stuff for something that they hold for a maximum of 6 months. The real sellers are the people behind the curtains, the people that really transferred it to qualified intermediaries to hold it for the sole purpose of effectuating a reverse exchange. But basically, it's just changing the purchase of the sale. Yeah.
What is a qualified intermediary? Let me example.
Qualified intermediaries have got to be an independent third party that is entrusted to hold the money in escrow. So when you sell, rather than the net sales proceeds being wired to you or your client, they would be wired to people like us who hold it in an escrow account until such time as they're ready to close. And again, rather than that money having to come from your client or you, that money has been sitting in escrow. It'll go directly to the attorney who's going to be closing the deal. So at no point does that money touch your hands. If that money ever touched your account or in any way that either actual receipt or constructive receipt, it will trigger tax in that mode.
I mean, I don't want to take Paul's job from him, but Eric, gosh, I got a buddy who's really good with numbers and he has a pretty sweet, high yield savings account. What if I just dump the money with him?
Well, I mean, the problem with that is, if it's just a buddy, it isn't an independent person. But again, you got to be able to navigate these waters. You got to know these rules. You need to know the restrictions on when funds can be returned. There are federal regulations that restrict that. We get a ton of questions from the very beginning all the way through, even post exchange, once the replacement property has been purchased. So, the buddy with a high yield savings account is just simply not going to be able to steer you clear of all the pitfalls that can blow the exchange, or create a world headache.
So going kind of back to a reverse 1031 exchange. So basically you said changes the chronology of it, right? So you're buying the replacement property first, and then you're selling the property that you have. But it seems like the intermediary, the attorney, it's a lot more on the attorney's shoulders, right? Because you have I can't remember the exact term you use, but basically an LLC that the attorney has created to hold this. And then there's timelines, I'm sure, and all different kinds of stuff. It just seems like it's a lot more legwork.
It's a far more involved because rather than just simply holding cash in an escrow account for somebody's benefit, you're now holding on to real estate for their benefit, which comes with this whole host of, okay, great, but make sure you're named on there as an additional name insured for all your insurance. And obviously you want security on it. So what happens if your qualified intermediary passes away mid-exchange? What happens to the title there? So you have, basically, if you want to get down into those details, but there would be an already assignment of membership interest in the entity that's holding the property from the qualified intermediary back to the original owner, so that it would be automatic and once certain events trigger that. But you need, again, additional documents to make sure all the bases are covered. So the reverse exchanges are far more complicated and, generally speaking, not preferable to a straight exchange if a straight exchange can be done. So if you got cooperating parties on both sides, it's like, oh yeah, we can delay the purchase, until the sale happens, then let's do it because it's cleaner, it's cheaper, It just makes everybody happier. But the important takeaway, I think, is that we have options. So, if the purchase has to happen before, it can still be done and the exchange can still be complete.
So for the straightforward exchange, we said, cost benefit analysis. What does that look like? At what point does it make sense versus when you should just be like, this isn't going to work for me. Reverse 1031 exchange. What is that point? We said $3,000 with the traditional exchange. What about reverse 1031 exchange?
They're on average between 7 or 8.
So 7 or 8,000.
Yep, a little more
Okay.
than double.
Yeah. All right. That makes sense.
But most people have tax liability that's far more than 7 or 8 grand. Again, with the cost benefit analysis, the cost of the exchange is rarely a consideration. It's really, how likely do you think you can succeed in doing it? Have you already identified what you're thinking about buying? Do you have your ducks in a row? Or are you confident that the market's out there and your real estate team is top notch, that you'll be able to get what you want and make everything happy?
So, I mentioned this to you when we spoke before, and I had a client one time work with you guys with Eric, never seen this done before, where he purchased a property that had one warehouse on it, and then he built 2 additional warehouses within that 6-month timeline and used all of his funds to do it. Never heard of it happen before. Can you walk through what that situation was, or what kind of stipulations he could do to make that happen?
There are basically 3 main varieties of 1031 exchanges without drilling down into the really minutiae here. But you got your forward exchange, which we just talked about. You got your reverse exchange, which we just talked about. The third variety would be an improvement exchange. So sort of a hybrid of the two. You're selling first and you're buying second, so it's still a straight exchange. However, you're trying to use 1031 funds that you have excess funds for, in order to build capital improvements on the property that you bought as your replacement property. The timelines are still the same. That's why they're very tricky. You still got to get it done in 180 days. So if you have no idea what you're going to buy when you sell your property, and you got to go out and hunt that down, you got to go through your period of due diligence, you're eating up a lot of time. Never mind that once you do buy it, then you start your permitting process. And as we all know, that's just not a quick process in any municipality. So again, those really only work for the people that really got it together. They can sell on this day and hopefully buy on the very next day, and I've already started their permitting process. Or the capital improvements that they want to do on the property don't require permitting. Maybe it's a gut interior renovation, and they can get a lot of this stuff done. Okay, cool. Then we're off to the races again. But again, chance favors the prepared in those kind of transactions. So the more you could really make sure you are streamlined and efficient, so you get as much of the 1031 funds used up before that 180-day deadline, the happier everyone will be at the end of it.
There's probably easier and less stressful ways to go about that.
That's right. Yeah. And for the record, this was like he bought the property. It already had permits lined up. Like he bought actually a lot of the material before we even closed. So like it was like day one, and he was off of the races. He was ready to go. Eric, is it the same thing where the intermediary is holding the funds the entire time? So are you like doing construction draws and stuff for new construction or capital improvements?
Yeah, the 1031 funds are still in the escrow account for the qualified intermediary. The reason why it is a bit of a hybrid transaction and similar to the reverse exchange is one of the big rules on an improvement exchange, because of this sort of artificial legal fiction of what the exchange is. It's the qualified intermediary is stepping into the shoes of the exchanger. It's our money, so you're going to sign the contract with the qualified intermediary because we're going to provide the money for the purchase. You're still the one purchasing it, but there's these legal fictions that we have to go through the charade of doing. With respect to a capital improvement exchange, it is deemed that it is the intermediary who's really using 1031 funds to improve replacement property. It is not the taxpayer doing it per se. So the requirement is for the period of time that capital improvements are being done to a replacement property, that property has to be temporarily vested with the qualified intermediary. So we're back to holding title to that replacement property at the closing of it. So Title will go to the new single purpose LLC, the sole member of which is the qualified intermediary company. Dole out the money as directed for purposes of the construction draws to the contractor, hopefully on a regular basis and not just every 2 days kind of thing. And then once the money is used up or the 180 days are done, or people say, listen, we got our CO, we're before 180 days and we still have money, then at that point, the exchange can be complete. Title goes back to the taxpayer. Any excess funds gets returned to the client.
Sweet. All right. Outside of 1031 exchanges, we talked a lot about 1031. What are some other common or lesser known tax strategies that real estate investors can use, or should they understand?
You dealt with some of that this morning.
Oh yeah, gosh. I had I can't say enough that communication is key. So planning, being ready for this. We had someone call in this morning at 10 a.m. We're closing at 1. Can we roll it into an exchange on a straight exchange? Had another one today. I closed last Monday. I have these checks. I haven't deposited them. Can I start an exchange? And unfortunately, the answer was yes and then no, depending on which one we were talking to. But we're hearing a lot of questions that are probably a little bit more accounting related as far as cost segregation analysis, starting with just a pure CBA, a pure cost benefit analysis, but then getting into that cost segregation and then advanced depreciation, some of the things that have been incredibly enhanced or increased with the bill that was signed last summer. I hear everybody call it the big, beautiful bill. I'm sure there was probably some other fancy, crazy name to it, but we'll go with Big Beautiful Bill. And it is the actual name of it. Okay, because normally they come up with like a creative, Big Beautiful Bill, we'll go with it. So, there's definitely some of that where you can really sharpen the pencil and look at that. And actually, I did some more research on it. It's not a all or nothing approach. It's not we're doing cost seg and rapid depreciation, everything else, or we're doing 1031s. There's actually some blending and hybridization as long as you're accountant, as long as the CPA understands it and is on board. So that's probably the biggest one. That's the hot button topic because it was just passed. I had a question on 721, section 721 come in earlier. They were looking for that. Same guy that closed last week said, I read about this. What about a 721? Well, it's still the same problem. You've already closed on the property that you're looking to,
What is a
to shield.
721?
It's a real estate investment trust. So it's looking at REITs, and the problem there, like Eric and I discussed earlier, is once you go down that path, you're locked in. You can't come back out to physical property. The other one that we see that is sort of tangential to 1031s, you can use 1031 funds for Delaware statutory trusts of DSTs. So that's where folks will sometimes park funds when they can't identify, I'll say, real property, as in, some dirt somewhere with an address and a TMS. They go into some of those funds to park and still continue on.
Qualified, an accredited investor for that.
Yes, that is part of the problem. You're exactly right. And so that's why I noticed I put it last. They get kind of fancy. We get into managed funds and it gets a little expensive, and then some of the other barriers of entry. So, to what we can speak to directly and informatively, it's definitely 1031s, but we are aware of some of those other options and avenues that can be a cooperative or blended approach, or can be maybe a replacement. I think, again, we talked about it, our barrier of entry for a return on investment is pretty low, but we're here to, one team, one fight, and ultimately it's the client, it's you, or when we're working with service providers and professionals like real estate agents, we're all here for the same purpose. So
Tax reduction steps, right?
Exactly. That's why I talked about that sharpening the pencils. They're the ones. They're the key member of the team. We can all sit here and say we're great and we're definitely a part of it, but the accountant is
I do
gotta bless it.
something that I think that you guys, or maybe I haven't knows that you said that 1031 cannot be with your main home. It has to be an income producing property. So
It doesn't have to be an income producing property, but she's absolutely right. It cannot be a personal use property.
Yeah.
So, but like raw land would not be
But, yes.
producing, and certainly qualifies as it does.
You buy it as an investment. Correct.
The income producing is where a lot of times when folks are looking at resident. No, you're okay. No, but it's a good
Very
rule.
good point.
It's a good rule of thumb as well, because a lot of times, we get into second homes and things of that nature.
Right.
And income producing, as soon as you check that box, boom, done. Even though it's residential, even though there may have been whatever use. So yeah, you're exactly right. It's another one of those 101 topics of
Yeah.
it is not for primary, residences. And it's not for personal use.
All right. Thank you guys so much. All right, let's take 5 minutes. We've covered a lot of ground. Let's take 5 minutes, go to our tables. Let's say something we've learned, a takeaway we've had with our groups. Let's come up with some questions, and then we'll bring you back up front and do the live Q&A with Eric and Johnny. So let's just take 5 minutes.
Just
Sorry.
on the tables, takeaways, questions for Eric and Johnny. Let's start with the back left table back there.
Do you want to?
Yeah, I had a question about, let's say, okay, so you do a 1031 and you own the property. And then you decide 2-3 years down the road, like, I have a year where it'd be great to have a taxable gain. And you want to sell that property. How would you go about identifying the IRS or identifying you or like letting you know that, you see what I'm saying? You're going to keep the property. You just want to take the gain. You have a $800,000 gain in that property. And then you say, I want to report the gain on my tax return and take that as a gain this year. I mean, they wouldn't like, I don't think the IRS would like trigger like a forced sale.
I don't know how to trigger a gain otherwise. I mean, sell it to a related party.
Sell it yourself, God, or self like.
I don't know that would be effective, but I mean,
So the only way to take the gain is to actually transfer time.
it's the only way I know that. I mean, unless you held it in a corporation and you transferred it out of the corporation, that would trigger the gain.
Right.
But otherwise, I can't think of anything. You're a CPA. I'm hoping you might be able to weigh in a little bit. I can't think of anything other than the transfer out of the corporate status that would trigger gain without sale.
You have to sell it.
Yeah.
There's no other way, because otherwise it's an unrealized gain.
What if you were
They
to
would tax you on the unrealized gains of your stock market.
Yeah.
Like, you can't only if you sell it's a realized gain.
what if you were to transfer title into an S corporation and then transfer it back out of the S corp?
So
Transferring out of the S corp should trigger.
so when you have an S corp, you actually have shares. And while the shares can go up and down, the property value stays the same. So in an appreciating market, which usually over time real estate appreciates, you're going to be losing money. So it's a complicated way to do that. It is possible, but it's really not advised to put property in an S corp.
Because a transfer out of that S corp would trigger the gain. But I'm thinking your question here is really off the wall. Not many people say, "Hey, how do I pay some taxes?"
You have to allow it, and also you have losses in 1 year.
Well, again, it's, your losses at this year, you want to harvest them.
Yeah.
But the only way I can think to do it without an actual sale would be to deliberately transfer it into some sort of corporate status where the transfer out of the corporation would trigger your gain. That's the only creative option I could think of outside of a sale.
Well, could you sell it to a partner?
Well, that's what I'm saying. You can do a sale to a related party.
Carry forward the loss because somebody you trust don't lose the loss.
You can lose the loss. The loss dies when you do. Even if you're married filing jointly, the loss dies when you do.
Yeah, it's unfortunate.
Same for the deferred taxes on a 1031 exchange. You can hold it till you die, and then heirs or whomever are going to get that step up.
They get the step up in
Mhm.
basis. Yeah.
Yep.
That's a lot nicer than having a loss of
Losing the
whatever.
losses.
Yeah, I mean, I'm with you on thinking about it as an equity, and it's like I can't, can't report that until I actually harvest it.
And good question, Jared.
What's up, buddy?
This one might not be as complicated as that. So if you're doing the hybrid where you were talking earlier about constructing multiple properties, if you have a trustworthy contractor, if you're getting close to that after 90 days, hey, you just pay the balance to the contractor. He can just build you for the remaining 200,000, or is there going to be the IRS is like, oh, you didn't have that? Totally. Then
Academically, no.
okay.
You're not supposed to use 1031 funds to prepay for services, and you can't just simply do it to pay for materials. It needs to be payment for capital improvements that have been completed on the property.
Okay.
From a practical perspective, I don't know how that's policed.
Yeah.
How do you prove where we were in the construction process on this date 2 years ago?
Yeah. Understood.
That's why Eric referenced CO, because that's sort of a documented line in the sand, but it's not a.
I rarely get to see a CO within the 10 exchange period.
Yeah.
Usually, we just run out of time and, all right, well, we used up this amount of money. It's back to you. We did it. We had a good run. We knocked out a lot of it.
The rest of it's coming out of your pocket.
So that's probably going to trigger some gain.
Yeah,
But a
exactly.
lot of these people also have some losses that they can carry forward, or they got deductions to offset it. So they're not a small gain usually doesn't phase with most investors.
Right. Yeah. All right. What other questions in the back? They can be from the back two tables. Just see my back.
I got a few. So kind of thinking back on the inheritance tax fund, this to 1031, I would assume the basis goes up, but does that go towards the inheritance tax, which I think now is going to be 30 million per couple?
Funding the value equity at death will go against your unified credit.
Okay.
Yeah.
Second question was just what type of 1031s are you seeing from investors that are looking to do 1031s out of residential? It's something that's more passive. Like kind of, I know you go from residential into like, for instance, a limited partner in a syndication deal. What else have you been seeing come across your table lately?
I mean, most people who want to go traditional just simply go from residential to commercial, triple net, they minimize the amount of management that a lot of these people, which is also what they truly want passive. So if you got a good management company and the numbers still work such that taking in those expenses and everything, it's still cash flows, they're happy. Otherwise, I think still the most popular one is still the DSTs, provided that they clear the hurdle of qualified investors and stuff like that. But a lot of people just like it for the appeal of the mailbox money.
Last one was, can you tap into a debt equity if you do it by doing 1031 exchange and then essentially take a loan or a HELOC out on that new property? And if you do that, does it have to be a non-recourse loan?
Generally speaking, the IRS, from my readings of it, have backed off on cracking down on the people who do refinances post-exchange. So you do the exchange and then you want to pull out the money. I think it's a good idea if you have a bona fide reason for it. But otherwise, a bona fide business reason for it. But otherwise, I see people do it all the time.
Yeah. It's a great question.
Yeah.
Bill, any other questions in the back? Sorry, before we go to the middle tables.
What was the 200% rule of thumb you mentioned?
What Johnny was talking about there is that for the most part, there's a three property rule for identification. You can identify up to 3 properties and you don't have to worry about what those properties are valued at. In the event that you need to identify 4 or more properties, one of 2 additional rules is going to come into play. One almost never happens. It's you buy everything you have identified. Basically, it's called the 95% rule. You need to close on 90% of the properties you identified for value. But, that happens only in the event that people know that they got to identify these 6 properties, but they're definitely closing on these 6 properties that they end up doing, closing on those 6 properties. The rule that Johnny was referring to, if it's 4 or more properties, and we're not worried about that 95% rule, the aggregate value of all the properties you identify cannot exceed 200% of the value of the property that you sold. So if you sold $1 million property, the aggregate value of everything you identified cannot exceed $2 million.
And that aggregates on both sides. Relinquished properties that are funneling into the exchange and then going and purchasing new on replacement.
What's the purpose of that?
Why? The idea for the IRS is like, listen, I have 2 rules in 1031s that I hate, and the 45-day rule is one of them. I think it's stupid. If you can get this done in 180 days, you should be allowed. The identification in a month and a half is so arbitrary, it doesn't make any sense. But the concept of these rules of putting these hurdles is like, I don't want someone to just slap down the old phone book and say, I really don't have anything to identify, but I'm pretty sure it's a trust account. And the IRS says, well, that doesn't cut it. We can't, we're not going to have this arbitrary rule and then not enforce it. So they put these hurdles arbitrary and maybe say, okay, this is what you got to do to pass the hurdle test, the identification test. My cynical perspective on it may not be there.
No. And it gets challenging when you're just chasing down, unimproved land and trying to put a value on it and get into, all those different ways to look at it. But yeah, that's the key. I love that euphemism of phone book and just one of those. So that's why addresses or TMS numbers are really great for proper identification.
It does give you a little room to play, though, particularly if these aren't listed properties. You know, all right, well, let's use our tax assessment.
Mhm.
Those are always.
Mhm. Exactly. That's what I'm. Yeah.
Let's go with the middle tables. Any questions?
We also have a lot.
The
It is.
let's say you had a investor who you were working with or had single family homes and they were trying to move into something that was, so they had 3 properties they were trying to sell and move into like commercial or a quadplex or something else. How does that look from, obviously they're selling to multiple people, that create time constraints, and some of the, let's say we're selling to one investor though. They were selling to an investment group and they were selling it that way. What kind of hurdles do you have there? Specifically to title of maybe how, let's say the investor owns one in ABC LLC and the other single family in XYZ LLC. Transferring title in and then taking possession. So even if you meet the deadlines and those kind of things, it's pretty speak title a little bit.
So there were 2 different questions there. I'm going to jump on the front half and then I'll let Eric take that back half. That's got a little bit more meat to it. No, I mean, I'll jump on both if you want, but the front half, you know, you were discussing if you have multiple properties that are funneling into exchange to create that, that replacement, you know, pot of money. There, you're exactly right, where you're starting to eat up your time if you don't have those rack and stacks pretty quickly. And you know, you may end up against the 45-day window and not truly know, is this one, you know, necessarily coming in or not. There's some thought process on, you know, it needs to just be, the exchange needs to be funded before day 180 and then back out. But you know, if you're trying to honor that 45-day intent on everything, then yeah, you want to have that closing as efficient and quickly as possible for multiples, rack and stack. On the other side, the way it's, you know, the title's held going, you know, on a outbound or a sale, and then on the replacement, we track to the taxpayer, right? So we use that term and the IRS uses that term. That's ultimately how that's going to happen. So, you know, single member LLCs and things like that are pretty straightforward. When we get into partnerships and stuff like that, it's when it gets a little bit more complicated. So if those 3 are just, you know, 1, 2, 3 Main Street, 4, 5, 6 Main Street, 7, 8, 9 Main Street LLC, then, and those are 3 entities, then you're fine because those are solo, you know, solo member LLCs. So I think that's kind of what you were getting at was, okay, I'm not holding title in the same fashion on all of my properties that I'm selling and looking to go into that multifamily or commercial property. Then that part's okay. Then when you buy the new one, you know, the commercial, you can absolutely hold that in a brand new entity of an LLC, so long as it's, you know, kind of matching the structure.
Matching the structure being the same. You can't go to a single member LLC to a partnership. You have to be the same. You have to be the same entity, the same ownership entity.
The big rule of thumb is you got to have continuity of taxpayer.
Yeah.
So the taxpayer that does the sale has to be the same taxpayer that does the purchase.
Yep.
When there's follow up on the first part, they were the timing. So property 1 and 2 sell, and the other property gets filled up and doesn't sell in another 30 days. Well, what's the timing then in relation to the 45 days?
The big rule is the first, if you're going to try and limit your intermediary expenses, then you probably want to try and force it all into one exchange. The first transaction to close will start the clock. So, you know, if another one doesn't close for 30 days, your 45-day was started already 30 days ago. The option would be is to say, okay, well, then we need more time on this one. We're going to create a separate exchange for that. You may still all buy that same commercial property, but you're going to basically, at that point, when you identify it in the separate exchange, you'll probably figure out the percentages. And even if it all still comes down to one taxpayer buying it at the end of the day, you can make it work, but you may choose at that point whether or not it behooves your client to structure it in multiple 1031 exchanges or still try and consolidate it into a single one. But if it's a single one, the first sale starts the clock.
Yeah.
There's some other questions.
You gotta know.
Yeah, we had a question about the reverse. They touched on it with the timing of what happened. What if, you know, you guys, let's just say you guys take title to that property on the front end, and a lot of people are looking at that property that is going away
as part of a down payment or something else potentially. And what happens if they're under contract and then that contract blows up? And then so you're holding title. Their lender with the old property is maybe shifting to the new or something like that. How does that unfold, or how does that work when now the person still has two properties, one that you guys are holding and one they're holding didn't go through in the reverse? How does that look, or how does that work?
So it sounds to me like you're saying the entire clock was run out, right? All 180 days.
days.
Well, the good news is you don't have a taxable event.
Yeah, that's the good.
Congratulations. You own two miles. Exactly. You just grew your empire accidentally.
Now you might need to think about a forward exchange when you do ultimately sell that property, because the reverse is no longer on the table.
Yeah.
So if you really wanted if it's a tax liability you just can't live with, and you do need to defer it because you don't want to pay it, at that point you're going to be considering buying another property.
That's what we see, is basically you just eating the funds of the reverse and then you're turning around and flipping it back into a forward.
One more, sorry. So
That's a great.
That's what we're doing.
so let's say you have someone and they do both flipping and rental property. I've heard the IRS. How do they look at when something is something, and what it is? How is that? When the rubber meets the road, what is that line? Because I've heard people trying to do things that were clear, it flips into a 1031 and actively doing it. And I'm just trying to understand, obviously someone holds a rental property for 10 or 15 years, that's straightforward. But what do those timelines look like, and what does it look like in a day-to-day practice of what you can do or not do
Academically, generally speaking, you're not supposed to have any benefit of a 1031 exchange if you are a dealer of property. If you're in it just simply for flipping, and the nature of your business is that, you're not supposed to be able to avail yourself to 1031 benefits. That being said, you've already identified it is a little murky. At what point does that happen? And you're probably way on this a lot more than I am, but there are private letter rulings out there that basically say if you've held a piece of property for a year or more, you get a positive presumption in your favor that you have the requisite investment intent when you purchased it. And so the burden proof shifts therefore over to the IRS, that they have to disprove that you are holding it as an investment or in a traded business. So general rule of thumb, a year or more would be nice. If it's less, everything will fall to the facts and circumstances that surround it. Is this the only way you make money, or are you doing it, in addition to some other things? So it's really not what you do for a living. So that would probably weigh in insofar as whether or not they disqualify it as an investor versus someone who is a dealer of real estate. So, I mean, again, it's hard to, I hate to pass the bucket and say it depends, but it really does. I have a lot of clients that unsolicited get an offer within months of when they closed on their purchase. And, taxes needs to follow the money. It needs to follow the investment first, tax second. Let's make good deals. Let's make money. And then we'll figure out what is a tax efficient way to structure it. And so I encourage them. It's like us, we're missing a few arrows in this quiver if ever challenged. And ethically, we're not supposed to advise people on now if they do get challenged. But if ever challenged, there's some difficult questions that need to get answered. And I don't know that we have all the answers, but I think you got a legitimate cause here that says you didn't put this on the market. You weren't just trying to flip it, but a good deal came along and you would be a good businessman if you ignore it.
It's amazing how change of title creates this beacon, and then everybody kind of rushes in to say, well, where are we at here? Why was that a good deal? What did I miss out on? So people be hungry.
Can I
Hold on 1 second. I just saw the time. I know we're past time, so I just want to be respectful of everyone's time. Can we Eric and Johnny have agreed to stay after and answer all the questions you have that I do. Just like one question. We just have a couple minutes. Any 1 or 2 questions left? Anyone else?
I have
Go ahead.
So I've already participated in a 1031 exchange with short-term rental property. exchange of triple net leases. Attempted the reverse exchange. I got an additional property. That's my own fault. I decided not to sell the other one. I have another one that is currently a short-term vacation rental, and I've owned it for about 19 years, always operated as a vacation rental. I'm thinking about moving into it now. So what happens if I do that? And if I, what if I move in and I love it and I stay for 5-10 years and sell it, or pass down my gift, or what if I move in a year later, I don't want to be there and I'm going to sell it?
So just to clarify, this is a property that you've done a 1031 exchange into, and it's an investment property that you're moving to your primary residence.
No, this one was the one that I'm thinking of moving into. I did not purchase it at that time.
Oh, okay.
It'd be a more interesting question if you did.
Yeah.
But you don't have any restrictions on that. You can absolutely move into an investment.
What happens when I do sell it? Do I have to sell it?
Then just the normal Section 121 rules insofar as
No, all the way. She has to recapture all the depreciation for the 19 years.
have you depreciated this property?
Oh yeah.
Okay, so then you're right. Depreciation's on it.
So I probably don't want to do that.
You would have to recapture the depreciation
I think-
whenever you sell it.
I mean, 20 years around here is probably a heck of a gain, but
Yes.
But she does bring up a neat thing insofar as the conversion. About the only two ways out of the capital gain race is that either you die and you get the step up in basis, or you convert it to a primary residence if it's violent. The neat thing is the IRS added additional provisions to Section 121 that basically said, okay, general rule of thumb is if it's your primary residence for 2 of the past 5 years, you'll get a $250,000 credit if you file single, or you get a $500,000 credit if you file a joint tax return. They amended it to say, but if you bought this property as replacement property in a 1031 exchange, well, now we got some additional rules. The big thing is you need to hold it for all 5 of the past years as your primary residence, not just 2 of the past 5 years. But what it's neat is that by putting that into the code, it's tacit acknowledgement that investment intent does sometimes change, or else the IRS would not say, okay, if you're changing from your investment intent, you're going to now make this personal use property. We acknowledge that it happens. You just now have a higher hurdle when it comes time to selling it. So a lot of times people don't realize that is an option if, what they're trying to do is at some point try to use the Section 121 credit for a primary residence to start harvesting out some of the gains on those properties. Doesn't work when you get so big, or if you've depreciated the Jesus out of these properties. But it is an option to consider insofar as a tax strategy.
And can we just give a round of applause for Eric? Guys, you have provided us with so much value. How could we as a community support you guys?
Just happy to be here. Think of us when you have people wanting to say we're going to exchanges.
How can the people in the room, how can they contact you guys?
keep the conversation alive. I've left a business card on everybody's paper. Hopefully it didn't just blend in, but if you need one, need a few, take it with you. Reach out to us. Eric and I, like I said, are a team. It's not just Johnny or just Eric. And, we're here to answer questions. Most of our day is spent answering these type of questions. And boy, we get some humdingers day in and day out, including, today, a couple of good ones.
Well, they were good to stay around, so feel free to talk to them about any other questions that you guys had. We have our next event is talking about investing in little home parks. We've got a great speaker lined up. It'll be on 3rd Tuesday, February. And then we have Deals, Donuts, and Coffee the first Friday, February 6th. So please come out to that event. But thank you guys for coming out and like us.